Welcome back to the American Coin Spot channel. Today, we're going over spot prices. I'm going to talk about the rare earth that China's got hold on, or U.S. military. Now let's get into it. Global Macro and Commodities Intelligence Report. Date, July 1st, 2026, compiled for Market Briefing and Analysis 1, Macroeconomics, Interest Rates, and the Fed Gap. Markets are digesting a fundamental shift under Federal Reserve Chair Kevin Warsh. The central bank continues to navigate a complex balancing act as inflationary pressures bubble up alongside major geopolitical supply shocks. The federal funds rate. The Fed is maintaining its target range at 3.50% to 3.75%. The Fed gap and expectations. While major institutions like JP Morgan project that the Fed will remain on hold for the rest of 2026, a wide gap has opened between conservative central bank projections and active market pricing. Strong employment numbers and persistent 2026 energy price shocks have driven traders to price in a hawkish rate hike much sooner than the Fed's official pause rhetoric suggests. Market sentiment. Equities and commodities are showing high volatility, often referred to as tiers on the trading sheets, as the market attempts to close this gap and guess whether the Fed will prioritize cooling persistent inflation or supporting growth through the back half of the year. 2. War moves and energy spot report. Geopolitical friction continues to dictate energy and commodity risk premiums. Crude prices rose slightly this morning, following statements from Iran rejecting direct bilateral peace talks with U.S. officials in Qatar, rattling expectations for a permanent resolution to the 4-month-long regional conflict. However, the broader narrative is one of significant decompression. The reopening of the Strait of Hormuz has successfully restored major maritime shipping corridors, effectively wiping out the massive fear premiums that spiked oil earlier in the year. Despite the morning's minor uptick, energy benchmarks are sitting well below their early 2026 highs, coming off a brutal quarter of declines. Energy benchmarks Brent crude, $73.45 per barrel, up 50 cents or 0.69% in early trading. Brent suffered an approximate $45 per barrel drop between Q1 and Q2. 2. WTI crude, $70.13 per barrel, up 63 cents or 0.91%. WTI plummeted roughly $31 over the previous quarter as shipping lanes cleared. 3. Precious and industrial metals spot report. Metals are seeing active profit-taking and technical pullbacks today. Gold remains highly resilient at historic elevations, acting as the ultimate macro hedge, while industrial metals feel the cooling effects of shifting global manufacturing demand. Metal spot prices and market context. Gold, $4,065.55 per troy ounce, down $35.30. This shows consolidation after historic runs above 4,000, heavily backed by Fed uncertainty. Silver, $59.28 per troy ounce, down 64 cents. This is tracking gold's pullback, though tight physical supply keeps a solid floor near 60. Platinum, $1,630.05 per troy ounce, down $6.85. The metal is under subtle pressure, though holding strong long-term industrial support. Palladium, $1,236.55 per troy ounce, up $10.80. Palladium is breaking away from the pack with a minor green day in automotive supply metrics. Rhodium, $8,350 per troy ounce, flat $0. Holding steady, specialized industrial demand keeps trading flat but highly priced. Copper, $6.20 per pound, flat $0. This is a consolidation phase, heavily tied to global infrastructure and electrification timelines. Aluminum, $1.12 per pound, or $2,480 per metric ton, down slightly. Aluminum remains vulnerable to shifting energy, overhead costs, and global manufacturing rates. Numismatic and bullion note. Retail premium indicators are tracking closely with these numbers. For physical delivery assets, standard 1-ounce gold eagles are drawing asks around $4,057 to $4,110 depending on the tier, while physical 1,000-ounce silver bullion bars are trading in the $58,245 neighborhood, as the physical-to-paper spread holds firm. 4. The China rare earth situation. The China rare earth situation has escalated significantly over the last few weeks. The temporary critical minerals truce has officially ended, and Beijing is moving from broad policy announcements to targeted economic enforcement. The strategy is shifting away from outright bans and moving toward high-pressure regulatory control, aggressive export licensing, and blacklisting. A. The weaponization of blacklists. The U.S. comeback targeted. Following the high-stakes May 2026 Trump-Xi summit in Beijing, hopes for an extended critical minerals truce were dashed. On June 22, 2026, Beijing abruptly blacklisted the two largest U.S. domestic rare earth plays, MP Materials, and USA Rare Earth. The trap. Because China refines roughly 85% of global rare earth elements, its extraterritorial controls legally prohibit any company anywhere in the world from transferring Chinese origin inputs to these blacklisted firms. This casts a massive chill over allied third-party suppliers who are afraid of losing access to Chinese material if they partner with the USB. The return of the 0.1% de minimis rule. November 10th, deadline. The ticking clock for global supply chains is November 10th, 2026, marking the end of the enforcement postponement for China's Ministry of Commerce Notice 61. The rule. Any product manufactured outside of China that contains Chinese origin rare earth elements accounting for 0.1% or more of the product's total value will require a formal Chinese government export license before it can be shipped to another country. Who it hits. High-end tech like massive AI GPU servers usually stays under the 0.1% value mark because electronics are so expensive. However, down-market components like permanent magnet motors, data center cooling infrastructure, medical devices, and EV powertrains will hit that 0.1% threshold instantly. C. Targeted enforcement against Japan, and the EU Beijing is also using its rare earth leverage defensively against individual geopolitical rivals. The Japan tensions. Following diplomatic friction, China added 20 Japanese entities, including subsidiaries of Mitsubishi Electric, to its strict dual-use export control list. In May, 2 Japanese employees of Fuji Electric were detained by customs authorities in Dalian, China, for allegedly trying to export industrial motors from which rare earth magnets could be extracted. The European front. EU Trade Commissioner Maros Sefcovic and Chinese Commerce Minister Wang Wentao just met in Brussels to open a formal trade consultation framework. European aerospace and automotive sectors are heavily exposed. Shipments of critical elements, like yttrium, which is used for coating jet engine turbines, have collapsed by over 95%, forcing Western manufacturers to strictly ration supplies. D. The ex-China rare earth pivot. To counter China's chokehold on heavy rare earths like dysprosium, terbium, samarium, and gadolinium, alternative hubs are expanding aggressively. Australia remains the primary U.S. partner. Australia's Lynas Rare Earths recently achieved a massive breakthrough by becoming the first company outside of China to produce commercial quantities of heavy dysprosium oxide at its Malaysia plant, using feedstock from Australia's Mount Weld mine, Saudi Arabia. Under a heavy U.S. strategic framework, Saudi Arabia is rapidly positioning itself as the critical minerals hub for Europe, the Middle East, and Africa. The U.S. Department of Defense is even financing a 49% equity stake in a brand new rare earth refinery in the kingdom to process materials coming out of Africa and the massive local Jabal Sayid deposit. Now, have a great day. Don't forget to like, subscribe, and hype the video, and thank you for tuning in. Oh yeah, and as an associate and influencer, I do earn commission on all qualified purchases made to these affiliate links and no extra cost to you, the viewer. Thank you.